Okay, good morning everyone. Assalamu alaikum. I think this is a good number now. Can anyone confirm that you can hear me and also see my screen?
Yes.
Okay, thank you very much. I have a question to you all. Raise your hand or just thumbs up if you think that you have done capital budgeting before in financial management class. By capital budgeting, I mean that you have done with NPV, IRR, net present value, internal rate of return, payback period, all these techniques. Can you please, do a thumbs up, or if you have done this before in financial management? Okay, so far I saw only few thumbs up. Anyway, it means that since most of you came from the same batch, so you have done NPV, IRR, and other techniques. So what we will do today is we will first discuss about political risk, a brief discussion on how or what we mean by political risk globally. And then we will move to capital budgeting, which will, as I said in the previous class, that this example is a kind of like an integrated problem of the entire multinational company investment. So we will take an example of a multinational company investing in another country, and we'll see step by step how all our discussion come into effect. Our discussion on foreign currency, exchange rate, our discussion on other relevant issues, how these come into effect, we will see today. And in the next class, we have a revision class. In the next class, we will revise only 2 chapters. One is the transaction exposure. We will do only the mathematical example and also this capital budgeting example so that it can help us for test 2. So about capital budgeting is that previously the capital budgeting technique that you have used, you have only possibly a very simple form of capital budgeting technique. So you possibly had some cash flows based on which you have calculated NPV, IRR, and other techniques. So in this chapter, what we'll try to see is the same techniques. We mostly use NPV, net present value, but we will do it for a multinational company. So we will see how investment in multiple countries affect your cash flow decision. So we'll go step by step, and then at the end of the class, I will give you one example, and in the next class, I'll give you another example. So I'll upload the solution as well. If you have any problem, you can ask me. You can email me as well. So let's go on with the discussion first. In this chapter, as I said before, our discussion starts with political risk first. So we will see how foreign portfolio investment, FPI, foreign direct investment, is basically investment by multinational company, and also political risk are connected. Okay, and then in the second section, we'll move to capital budgeting for multinational company. How this chapter is important for value of a multinational company, as you can say from our previous discussion, that the value of a multinational company is different from a domestic company because the exchange rate is involved, and the cash flows of a multinational company will be adjusted for the exchange rate in order for you to calculate the value of that company. Also, political risk will influence not only the cash flow, but also will influence the risk factor. K, cost of capital will be very high in politically unstable countries, and cost of capital will be low, relatively low, in countries where political risk is very low. For example, Japan is one of the countries where cost of capital is very low. The reason they have a low cost of capital is because Japan is typically or generally a country where risk factors are very minimum. There are other countries where in recent days cost of capital is increasing, for example in Hong Kong because of political unrest. In India also, the cost of capital components are quite unstable because of the political risk. For COVID-19, globally, cost of capital is generally a little bit higher because of relative uncertainty. But due to COVID-19, people have spent less, so there are a lot of money in the banking channel. So that should reduce the cost of capital. So during COVID-19, cost of capital did not increase per se for political risk, but it has increased for relative uncertainty. So we'll discuss about these factors, and we'll try to see how political risk factor can be minimized or can be managed by the multinational company. Let's start with a very basic discussion on portfolio theory. Okay, portfolio risk reduction. Our intention is to look into risk reduction through diversification. The reason why we do, let me maximize this part. See one by one chart. Okay, chart number 1 at the left top corner. If you remember your discussion from financial management, there are two major types of risk that we generally face in an investment. The lower part here, you see below the dotted line, this risk is a systematic risk. Now, systematic risk is the one that cannot be reduced directly simply by investing in another country. If you are investing in more and more country, a part of your risk will be reduced. This part, the one that is reducing, this part can be reduced by increasing number of investment. We call it diversification. What is diversification? When you are investing in more than one asset, when you are investing in more and more companies, when you are investing in more and more share. So this is a number game. The more investment you do, lesser would be your risk, because you are not concentrating all of your investment in one asset. You are investing in more than one asset, therefore your risk is shared. But there is risk that cannot be reduced, that cannot be shared, even if you are investing in 100 or 1,000 assets. That part of the risk is called systematic risk, or undiversifiable part of the risk. Systematic risk generally comes from systemic events or major events or financial crisis, or for example, war. There's a war happening between two countries. That is the risk that you cannot reduce by simply increasing your investment. So when for example, COVID-19 is a systematic issue, and it created a risk we call systematic risk that cannot be reduced by simply increasing number of assets in your portfolio. So we need to understand for a multinational company investment risk, what risk you can mitigate and what risk you cannot mitigate. Some of the risk, even after becoming large multinational company, you won't be able to reduce those risks. Now, let me tell you about a unique risk. For example, cultural shock, cultural risk. So, for example, you have something in mind about a country. When you go to that country, you see some completely different thing. Or, for example, the culture in a country is against the culture of the company. So that can be a systematic risk for which company has to change a lot in order to serve that customer. Let me give you an example. 25 years ago, when Starbucks was initially expanding its market into different parts of America, at that time Starbucks was literally hated in the African American community in the US. The Starbucks then did a study why the African American community, sorry to use this word, but it is easy to represent the Black Americans, they call it. So let's call it African American community. Why they didn't like Starbucks? So they did a study and they found that, well, the Black Americans or the African American community, they did not like coffee. So it's a cultural shock for the company. So the company that is in selling coffee, they couldn't sell it to a group of customer because that customer group culturally or biologically, they did not like coffee. So this kind of shock that can happen, and you need to have a capacity over the years to convert that shock into something positive for you. So that's how many of the innovation came to Starbucks in order to serve this kind of customer. So we need to understand what is the risk that we can minimize and what is the risk we cannot minimize. Okay. The next, sorry. Next chart is how about investing in two different locations? For example, the same systematic risk. Remember, the systematic risk was this much, right? Systematic risk was this much in the previous chart. But if you are investing in more and more countries, you will still have systematic risk. For example, the lower part, you will still have systematic risk, but your portion of systematic risk will drop. You will still have 12% of systematic risk, but your systematic risk is dropping from 27 to 12%. It will be still there. You cannot completely wipe it out. So by adding number of stock, for example, only US market, if you are adding number of stock in US market, instead of investing, for example, in one company, you are now investing in 1,000 company. You will still have this portion of systematic risk still there. You can reduce a part of the risk. Those are related to number of stock, but a part of the risk you cannot reduce. What if we invest now in international market? Apart from US market, if I invest in, for example, Asian market or European market, that will give me some leg up. That means a part of the risk, part of the systematic risk would be reduced. But then again, another portion that also again doesn't depend on that international market. It depends on possibly global market. So that part of the systematic risk will still be there. So the conclusion is that even though MNEs or multinational companies are very big, they have capacity, they can invest in many more companies. They have billions and trillions of dollars. Last week, I think this week, Google became the third company. Actually, its mother company, Alphabet, became the third company, becoming $2 trillion company in terms of valuation. So these companies, Apple, Microsoft, Google, they have massive amount of cash flows, massive amount of investment to make, but they still cannot solve number of global problems, like problems related to cultural shock, war, COVID-19. These kind of crises will eventually affect all companies and all investment. Therefore, multinational company need to understand before going into any country what kind of systematic risks they are taking about that country. For example, now when you are choosing a country now, you obviously want to escape or deselect any investment in, for example, Afghanistan. You do not want to directly invest in, for example, some of these Asian countries, where there are still uncertainties going on. For example, Sudan was having trouble, political crisis since the last 2 weeks. So COVID-19 plus political risk is putting a lot of these countries into a major chaos. So if you are planning to invest, in some of these countries, you will reconsider, you will reevaluate what kind of risk you can take and what is the impact of those risks on your portfolio return, on your return to the mother company. You need to evaluate them, step by step, all the type of risks that you can take and that you can manage. The third chart is about reaching an optimal portfolfolio. So this is basically, it's a capital market phenomena. It's not directly applicable to foreign investment. It's not directly applicable to physical investment, for example. But you can do it. You can draw it. Up to you. These are possibly this chart, especially this chart, might be a little bit unknown to you right now. I'm not surprised because we discussed this portfolio formation in a course called Quantitative Financial Techniques or Portfolio Theory. We discussed in a course called Portfolio Theory. So that course is not available in UBD right now. So therefore, many of our finance students do not see this kind of calculation. One of the reasons why we do not have it in Brunei, because Brunei doesn't have a stock market. So nobody in the past actually took this initiative to introduce this course in Brunei. I tried to do it, but I failed because I could not justify what's the benefit of introducing this course. but in any market, in any universities, even if they don't have a stock market, these are very basic courses available. So I hope that in the future they will introduce this course, and the students will be able to learn how to choose a portfolio that is optimal. So right at this moment, since I believe that it would be a little bit too high level for you, but I'll try to explain in easy manner. What I did actually in our master's course, I take one of the master's course, Modern Financial Theory. In the Modern Financial Theory course, I included some of this aspect, apart from international finance that I'm teaching you, previously was not available in that course. So I try to include these quantitative finance issues as well, because these are very basic issues that students need to know. So I teach this graph and calculations to students in the class, in that chapter, in that course. So this chart is actually, there are a number of charts here. There are a number of charts here. So you can actually draw your risk and return. I think you understand risk and return. You can draw your risk and return combination of multiple assets together. You can draw them. So let me go step by step. This is the in the y-axis you have the risk, and in the in the x-axis you have the risk, and the y-axis you have the return. So y means the dependent variable. So return depends on risk. So that's why in the y-axis you have the return of the portfolio, return of the asset, and in the x-axis you have the risk of the asset. Risk does not depend on return. So return depends on risk. If your risk is high, your return should be high. Your risk is low, return should be low. So we are drawing possible combination of risk and return based on whatever investment possible for a company. So they have two drawing. One is, let's say this one is first one, let's say line A, and they have another line, for example, this is line B. Okay, these are the lines actually showing possible combination of return and risk. So there are a number of points here, depending on what do you call it, depending on the calculations and points available for risk and return. There are a number of risk and return points available here. So depending on these risk and return combinations, they will eventually find out which one is the optimal, which one is the most balanced investment for the company. So the most balanced investment here is, there are two investment opportunities they found. One is for international investment, IP, okay, and the other one is DP, for possibly it's a domestic portfolio or domestic investment. So what they are trying to show is that the international investment has much lesser risk. You see, this is the risk part. So left side is lower, the right side is the higher. So international investment is lower risk compared to the domestic investment. So they try to show using chart that, and they are also suggesting that when you are investing in multiple companies, or you are buying share of companies, you try to include international market. So do not just invest in, for example, Singapore. You are buying share from Singapore. Do not invest only in Singapore. Try to invest also in other markets. For example, the European market, can be also neighboring market like Thailand, Philippines, Malaysia, Indonesia. You can buy also from India. So if you are buying investment from more diverse market, your risk will go down. You will have a stable return, so that you don't need to create shock in your return. So when multinational companies are forming similar portfolio of investment, when they are planning to go to different countries or for investment, physical investment or financial investment, they do prepare this kind of chart in order to see where the demand and supply meet. This what do you call it? Black color straight line is basically the demand curve. You remember the demand and supply interaction that gives you the equilibrium point, right? So you need to have a demand and supply line in order to be tangent or intersect in some places in order for you to choose the equilibrium point, right? So the black color line is basically the international capital market line that shows you the demand line or the investor's capacity. And on the other hand, the curvilinear line, the blue color line that you see, the curved line, this line is basically the supply line. Supply line shows the all combination of risk and return possibility for assets. So the supply of asset and demand from the investor intersect in one place to find out which one is the optimal investment for investors. This optimal investment is theoretical, it is mathematical. You need to discuss it further. You need to discuss with your sales team, you need to discuss with your financial team whether we can achieve this portfolio investment, whether we can achieve this investment in international market. Because you may theoretically find that, well, Afghanistan is a good investment, but in real sense, in practical sense, maybe Afghanistan is currently the riskiest investment possible, right? So you might be also thinking that, well, United States can be a good example for investment. But in the first class, if you remember, for international finance, I showed you that some of these top countries are offering a lot of economic freedom, but they are also suffering from economic recession. So you need to the objective of these three charts is to show you how to choose your next possible international investment destination, how you choose another country. Are you choosing Malaysia for investment? Are you choosing Sabah or Sarawak for your investment? Are you choosing, for example, Bangkok for your investment? How do you choose the next possible country for your investment? These investment decisions are made after considering multiple risk aspects for the investment for your company. In the next slide, we will talk about some return and risk issue in international market, some correlation issue in international market. This will help you to understand how correlation, how relationship between markets are really important. For example, this is the correlation with US equity market. Let's say your home country is US, United States, and what is the correlation of other markets with US market? For example, Canadian market is almost 75% correlated. Okay, the lowest would be, for example, the Hong Kong market is the lowest correlated market with the US market. There are also other markets up to 60% correlated. Netherlands, United Kingdom is almost another 60 or 55% correlated. 50% correlated with the Australia. So the reason why we are considering correlations here, based on risk and return calculation that we have done, I'm assuming right now that you have done this. So in portfolio calculation, risk and return calculation, this is the way we represent correlation coefficient. We call it Spearman rho. This sign is called Spearman rho. This correlation can range from -1 to +1. So your asset can be negatively correlated, your asset can be positively correlated. Possibly in statistics course, I'm not sure whether you have taken any statistics course, they have discussed all this. So correlation can be -1, correlation up to can be +1. There can be negative 100% correlation, there can be positive 100% correlation. Now in risk calculation, if your assets are positively correlated, that means you are taking too much of risk. Okay, if your assets are positively correlated, your assets are risky. If your assets are negatively correlated, your assets are less risky. Let me give you an example. Let us say you have bought a share. You have bought a share of two phone companies, for example, Maxis and DG. Okay, these are both listed in Malaysian market, and you have purchased the share of both phone companies. These are both phone companies doing similar business, and their business correlation will be more than 90-95%, right? So what happens is when you have positive correlated asset, if anything happens to the mobile industry, okay, let's say there is a massive crisis in mobile industry, right? So you are not only losing money on Maxis, you are also losing money on DG. So positive correlation, okay, 100% positive correlation between two companies may eventually put your entire investment into risk. So if you take two assets or two countries investment, those are negatively correlated. Okay, negatively correlated, which is very rare to get, but you can try. If the investments are negatively correlated, even if one company is in trouble, even if one share is in trouble, the another share or another company or another country will still give you some benefits. So we try when we do portfolio investment, when we choose another country, we try to choose the countries those are having less relationship or unrelated businesses. Okay, we try to do unrelated businesses. If we diversify into unrelated businesses, our risk would be the lowest, because if one business is in trouble, it does not influence the other business. The other table here showing basically correlation estimate for different studies, and these correlation estimates are shown for different countries: US and Canada, Denmark, France, Germany, Switzerland, US and UK. And this is an average correlation. Most of the countries are having positive correlation with US, meaning that if anything happens to the US market, we'll eventually move to those markets. So there will be some risk that you'll be taking if you are investing in these markets. Especially if you are investing in Canadian market, you are taking the highest risk, because US and Canadian markets move together, almost together, 80% correlated. So if anything happens to the US market, immediately Canadian market will be affected. So your investment would be facing a lot of risk. Let's come to the political risk theory. But before going into political risk, let's talk about the theory of FDI. We have discussed a little bit of this in the first International Finance first class, but I'll give you something in detail. In order to become a multinational company, you need to make number of decisions. You need to make number of decisions. At least 3 decisions so far I remember. The first decision is, in order to become a multinational company, the first decision is whether you can sustain and transfer your competitive advantage. I think you understand competitive advantage now. This is a quality, this is an ability, this is a product line, this can be your product, this can be a production process, it can be specific raw materials that you have, something that you have in your company that is you can capitalize on to get advantage. We call it competitive advantage. This is the ability or resource that gives you a competitive edge over your competitors. That means you'll be able to use this competitive advantage to get some additional return, right? So you need to decide whether you can sustain, you can take advantage from this competitive advantage for a very long period of time, and at the same time you can transfer it. Okay, you can transfer it, you can modify it. You have to also make sure that your competitive advantage is not easily copied by other people, like Chinese people. They can copy anything. So if you send a product to China, they will copy within what, half an hour. So then your competitive advantage is gone. So you need to make sure that your competitive advantage is not imitated, it's not copied easily. So under this decision 1 about competitive advantage, there are certain elements that we need to look into. There are at least 6 elements. Sustaining and transferring competitive advantage is related to first one, economies of scale and scope. Okay, I think you understand what is economies of scale, where you are dealing with large size or number of N, increasing your production line, increasing your number of products, okay, so that you can reduce per unit of cost, right? This is cost reduction. Basically, it gives you a benefit of cost reduction. So when you have a competitive advantage, you can take advantage of that specific product line or resources that you have in order to reduce per unit cost. Second one is managerial and marketing expertise. So you may have a competitive advantage of managerial and marketing expertise, right? Your marketing team might be very good, like Apple's marketing team. They literally change nothing in a product, then do a very good marketing in order to kind of like market the product very well. So you may have a very good marketing team, and that can be your competitive advantage. Your competitive advantage can be advanced technology. Okay, like Facebook is going into metaverse, right? So metaverse is what they think is going to be the next generation of social what do you call it? Social business and economic places. So you basically sitting in your room wearing a Google Glass or Facebook Glass, and you're basically enjoying your office, enjoying everything, whatever you want to enjoy, So they want to bring basically their entire life into your PC or into your internet, into your home. That kind of advanced technology, people like these things nowadays. The impact is huge. Impact is huge. If you can bring everything to for example, augmented reality, using a glass or a VR set, a virtual reality set, then you don't need any classroom. It would be really good for UBD. UBD classrooms don't have chairs and tables properly, so they can have VR set. Students can buy them. You have to buy. University will not help you to buy them. So if you buy VR set, as a lecturer, I also have to buy one for possibly. So in the next 5 years, think about it. Your entire classroom concept will be gone. Lecturer will be sitting in the room, and students will be also wearing VR set to connect to each other virtually. This will be a virtual classroom. So entire classroom experience will be virtually there. You can choose your avatar, and you can see that as a cartoon, you can move around, walk around. So that's advanced technology, can give you some additional return that can be your competitive advantage. Let me tell you, in the computer industry, for example, Macintosh is completely designed on Unix system, UNIX, Unix system. So they believe that it is a advanced technology. It's a different technology. For example, now Apple is moving into a complete different chip system, silicon-based chip system, which is basically giving them a completely different new look. They are now eating up basically the business of Intel. So Intel used to produce all those chips previously. Now Apple is producing their own chips and taking control of the business. So that advanced technology can be your competitive advantage. Financial strength. Some companies can be financially very strong. That can be their competitive advantage. Okay, especially large companies. They can have a very strong financial backup, so that anytime they go to international market, they have the money to invest. So financial strength can be your competitive advantage. You may not be doing very good business. You might be just doing okay, but possibly you have a very strong financial base. Maybe your owners are very rich. Maybe you come from a very rich country. Your company is very rich. Because of that, your financial strength is very strong. Therefore, it can be your competitive advantage. Differentiated products. Maybe your products are unique. These are different from the competitors. Therefore, consumers like it and they are ready to pay for it. So differentiated product can be a competitive advantage for your company. How do you differentiate? That's a long discussion. And in finance, we typically don't discuss about it. It's a marketing and management issue. So this is to talk about research and development, innovation, brand identification, all those marketing and management and branding issues. But differentiation generally gives you benefit for in terms of consumer return. Consumer will like your product, they will purchase your product, and eventually your revenue will increase. So differentiated products can be one of the competitive advantage. Finally, competitiveness of the home market. You might be very strong in your home market. That can be your competitive advantage as well. For example, Volkswagen is a strong, car manufacturer company in Europe. They're very strong in Germany. There was a case study I read in Harvard Business Review. They said, I think it was also partially published by Bloomberg Business. They say in that case study that if you want to know about German economy, look at their cars. So as long as their cars are doing good, they are doing very good in economic conditions. So their entire economic processing system, the engineering system, the innovation system are all revolving around their cars. So as long as Volkswagen is doing good, the German economy is doing good. Germany is one of the strongest economies in the world. So you might be very competitive, very strong in your home market. But if you consider Toyota, Toyota is not a very strong company in Japan. Toyota is a very strong company outside. Okay, so you may not be always strong at home and international market. For example, in Japan, auto market is very competitive. Toyota is fighting with many emerging brands, including old companies as well, Mitsubishi, Nissan, and all other companies they are fighting with in Japanese market. In Korean market also, they have two companies. Those are owned by the same mother company, Kia and Hyundai. So the Korean market is also is a very good example of competitiveness in the home market. So you might be thinking that how this can be capitalized on. If you are very strong in your home market, you'll be able to spread this rumor, spread this impression to the outside investor that this company is a very good company in their country, and you can sell a good amount of product in your home country. If you can capture your home market very well, you can reduce international competition in home market, your revenue will go up, and you will be able to spread positive impression about the company outside. So these are some of the examples of competitive advantage that you can capitalize on and possibly move on based on that. This is an example of very old example by Michael E. Porter. I think you have heard about this person. This was a professor of Harvard University. He's still a professor at Harvard University. Michael E. Porter was one of the youngest professors in Harvard University. He created this in 1990 based on his thesis that there can be national competitive advantage or national advantage. He used to call it national advantage framework. This is related to 4 strategies: factor conditions, demand conditions, related industries, and farm strategy, structure, and rivalry. So based on these, you would be able to produce a framework for your company, whether you have a specific competitive advantage or not. So these are at the national stage. These are not at the corporate stage, at the national, at the country level, regional level, competitive advantage. So you can look into factor condition. Which country is good at land, labor, capital, and technology? These are the 4 factors of production. 4 factors of production: land, labor, capital, and technology. Which countries are good at what? You know, some countries are good at land. They have massive land. They can open this for production. Their agricultural outputs are very good. You know, some countries are very good at labor. Their labor cost is very cheap. Some countries are very good at capital market. Some countries are very good at technology and innovation, right? So you may not get everything in one country, but obviously you will get a good combination of things in countries. For example, if you go to US, they have land, they have capital, they have technology, they don't have labor cost. So US labor cost is very high. That's why they go to other countries to produce at a low cost. So similarly to factor condition, you can look into demand conditions. How are the consumers reacting to new product, whether they are buying? Are the consumers demanding? Are the consumers diligent? They're sophisticated? You know, what kind of consumers they are? What is the demand condition? Depending on the demand condition, you'll be able to produce goods and services and attain competitive advantage. Related industries. Do you have supporting industries? You know, do you have supporting industries in that country? Or do you have supporting industry for your company? Let's say you have produced a product and the supporting industry is absent. Okay, so your product will not be sold in the market, right? So you need to understand whether there are supporting or related or vertical integration, they call it vertical and horizontal integration, available or not. Last one is farm strategy, structure, and rivalry. You need to see how is the competition, you know, whether your company is facing too much of competition, you know, which country is facing too much of competition. You need to identify, you know, the countries where there are a lot of competition in local market. If you have too much of competition in local market, possibly it is a good strategy for you to go outside or maybe restructure your company so that you can reduce competition. So this is Michael E. Porter's national competitive advantage. Next one is another example. We call it OLI. Okay, OLI framework is was initially given by Dunning, D-U-N-N-I-N-G, Dunning. Professor Dunning talked about OLI paradigm, which is basically owner-specific, location-specific, internalization. So these are the 3 OLI. Let us decide OLI paradigm. So this is also this will also help you to understand and identify which market you are going to establish your business. Okay, so OLI, some competitive advantage would be owner specific. So meaning that as a owner of the company, you will have some competitive advantage to home market or foreign market. Okay. Next one is location specific. Some competitive advantage would be location specific. For example, low cost labor would be available at a specific country, specific location. It may not be available in all over the world, right? So some competitive advantage would be location specific. For example, if you want to produce garments product, you will go to China, Vietnam, or Bangladesh. You will not go to Pakistan, for example. So you will not come to Malaysia to produce garments product because this competitive advantage is location specific. Next one is internalization. Internalization is that your company, that those companies are very competitive internally. Okay, they have control over the entire value chain. Okay, they have control over the entire value chain of the industry, meaning that you will have vertically integrated industries, you will have supporting industries to support your product, and you will have control over vertical integration. Let me give you an example. Previously, Coca-Cola used to buy bottles from outside. So the bottling industry was giving them a lot of pain. So what they did is now the Coca-Cola assembly line includes bottling plant. So it starts with a piece of plastic, and it becomes a bottle. The bottles are refilled with syrup, and eventually, plastic wrapping comes out, the Coca-Cola logo and everything, then capped it, put it inside a box, and it goes into the truck. So the entire assembly line includes bottling plant. So you have now control, Coca-Cola has control over the entire value chain. Okay, that's how you get to use your competitive advantage. This is an example of finance specific competitive advantage, finance specific factors, okay, for OLI. You can look into, again, ownership advantage, location advantage, and this is I don't know, maybe it's a mistake or something. This is actually taken from the book, but it is, I think, a mistake. It should not be internationalization, it's internalization. Okay, internalization. So this is a typo made by the book anyway. So internalization, location specific, ownership specific. You can look into what can be a proactive financial strategy for the company, what can be a reactive financial strategy for the company. Just take one example, a proactive example in ownership specific. If your competitive advantage is ownership specific, what you can do, you may do strategic cross listing. Maybe you can list your company in multiple markets. Okay. What else you can do? Maintaining competitive credit rating. Okay, you'll try to do competitive credit rating of your company. Maintaining financial relationship. So you'll try to establish relationship with banks and other financial institutions. What can be an example of location specific strategy? For example, you'll be trying to source capital globally. Okay, this is location specific. So you'll go to Hong Kong for money, Singapore for money, you'll go to London for foreign exchange management, So every location has its own specific competitive advantage. You'll try to get them. Maintaining competitive credit rating and also negotiating tax and financial subsidies. Now, tax benefit is location specific. You may not get the same tax benefit globally. Okay, so for example, if you come to Middle Eastern countries, many of them give additional tax advantage. Dubai gives you tax credit so that you can come and invest. So you will have to look for these benefits. Those are location specific, ownership specific, and internalization specific. Decision number 2, where to invest. Where you are going to invest, that's the decision number 2. First decision was whether you have competitive advantage and how you can sustain it. Okay, so we understood what is our competitive advantage and how we can take care of it. Second investment decision is where you are going to invest. So this decision is generally related to location, choosing the next location of your investment. For example, if you are planning to invest in agriculture, are you going to invest, for example, in Tutong, whether you are going to have your agricultural plant in Kebi, or you are going to have in Temburong, or you are going to go completely outside of Brunei, maybe to Sabah and Sarawak, or maybe other regions. So it's a locational decision. You need to choose the right location for your company. And these locational decisions are very tough. These are process oriented. It takes a lot of time to finally get a good location for your company. This is the process that we follow. I think this search pattern, we call it FDI, sequential search pattern. So this is a sequential search. sequence. It follows a sequence. It follows step-by-step sequence. So when you are choosing the next location for your business, you will also step-by-step go through this. We have discussed it about in the first class, but let me also discuss it again. So when the company identifies that they have competitive advantage and they want to capitalize on that, they will most probably will try to find out whether they are going to exploit it. So when you have competitive advantage, obviously you want to exploit, you want to use this competitive advantage to make some additional profit, right? So if you are taking advantage of these competitive resources or competitive advantage that you have, you will decide whether you are going outside, okay, abroad, outside. If you want to take this competitive advantage outside and use this to produce goods and services and sell it to a new consumer outside, you need to make a decision whether your production would be at home and then you will export to the foreign country, or you will be producing outside. If you are producing outside, you need to acquire production factories, you need to talk to laborers, you need to possibly talk to the bank for money. So there are a lot of challenges coming up. So production ahead in the foreign country or in your home country. If you are choosing that foreign country would be your location for production, then you need to make a decision about contract, whether this contract with the in the foreign country would be a licensing contract that you give a license to another company, they will produce it for you and they will sell it in the foreign market. Or you are going to control your own asset outside, meaning that you'll have your own factory, your resources, you'll collect your raw materials, you'll produce goods and services, you'll control your vertically oriented industries, your supporting industries, and then you'll produce goods and services outside. If you're thinking about directly controlling your asset, you might be thinking about a joint venture initially with a company, with a local company. You will have a joint venture. That company might be well established in terms of raw materials management and others, and you only would be doing the capital part or something. Opposite to that, you may consider a wholly owned, fully owned subsidiary. You may establish your subsidiary in a foreign location, and then from that subsidiary, you will start producing goods and services and sell it to the foreign market. This is the one we will give example today. In the numerical example, this is the one we'll try to pursue, and we'll give example of this. Now, when you are having a fully owned subsidiary, are you talking about a completely starting a new subsidiary as a greenfield investment, or you are purchasing a foreign enterprise? You are purchasing an existing business that is doing similar business. You are going to purchase it and extend the operation or refine the operation, or you are going to start completely from scratch so that you can bring your own technology and your own manpower to the business and start it completely from scratch in the foreign location. So this is a FDI, a foreign investment sequential search pattern. This is the way we move to another country or another business gradually, step by step, to choose what is the location good for us and how we go into that location as a strategy. For example, McDonald's has a mixed policy. When they come to, for example, in Brunei, their operation is managed from Singapore, and then they have a franchisee agreement. They don't have a licensing agreement directly. They have a franchisee agreement, and in every franchisee all over the world, McDonald's own the real estate. So say, for example, in Jeodong, the place that you see, that is actually owned by McDonald's. So McDonald's, in other words, it is the largest real estate company in the world. Last decision is how to invest. Okay, these how to invest is I'm not going to cover. These are international business issue, but I'll try to cover the big headings so that you get some idea. We have also discussed some of this already in the chart, but let's look into it. You may want to do exporting, or you want to do production abroad. Okay, you may want to do licensing versus control of asset. Okay, how to invest. You may want to do a joint venture versus a fully owned subsidiary, or you may want to do a greenfield new investment versus an acquisition. Okay, purchasing an existing business. You may also go for a strategic alliance with another company. A strategic alliance is to form an alliance with another company so that you can attain or achieve some strategic resources. Okay, that is the reason why you do cross-border strategic alliance. There are many companies practicing strategic alliance in international market. Those strategic alliances are can be even with your competition. For example, in 1997, I think. Let me think. Yeah, in 1997, when Steve Jobs came back to Apple, at that time the #1 competition of Apple was Microsoft. But he announced that Microsoft is going to have a strategic alliance with Apple. At that time, Microsoft actually purchased Apple's share of, I think, $115 million and saved Apple from completely going bankrupt. Today, Apple became one of the largest companies in the world. So that strategic alliance with Microsoft, with the competitor, actually eventually helped them. So you may need to find out a strategic alliance with someone in a foreign land in order to start your business. So how to invest, right? There are 3 trade-offs that you need to look into. You need to look into 3 trade-offs, three aspects that you need to make a balance of international business. First one is whether you are going for volume of production or you are going for margin. Okay, profit margin, sales margin, or you are going for a volume of production. Rapid expansion versus low leverage. You want to grow very fast, or you want to depend on less leverage, less debt, so that you can have ownership concentration. Your owners can control everything rather than asking for money from outside. If you do rapid expansion, you need fund from outside, fund from bank, and your liability will increase. Growth versus dividend. So are you looking for a growth-oriented company where you do not offer any dividend to the shareholders, or you are relying on dividend-based company where you make profit and offer dividend to the shareholders? Depending on different types of location and different types of company, your strategies would be different. Your trade-offs must be based on the kind of country you are dealing with, kind of product you are dealing with, and obviously your strategy, your internal strategy. There are a lot of FDIs or investment nowadays originating in the developing countries. Previously, FDI was a thing of the developed country, that these developed countries are making investments into developing countries. But nowadays, there are exceptions where developing countries are introducing a lot of foreign direct investment. Let me give you an example in the next slide. These are the examples of emerging market multinational and their global strategies. So say, for example, there are a number of them from Mexico. There are a number of them from China, Brazil, Russia, China, India. Infosys is from India. Mahindra and Mahindra is the truck manufacturer from India. They have also, for example, some of these I also do not know. Shanghai Biosteel from China. Tata Consultancy is a Tata company subsidiary from India. Tata Motors, another famous company from India. Tata owns actually a lot of companies. They own a lot of auto companies, good auto companies in the world. Wipro, another company I know. I worked for Wipro previously, long time ago actually. That was 2004, 2005. I was a financial analyst for Wipro. Is a good Indian company that basically in IT solutions. It's an IT solutions company. So my job was in financial department. I was a financial analyst for Wipro. Very short period of time, but I enjoyed working with this company. It's a totally innovation-based company. So these are companies. Those are coming from emerging markets, and they are becoming bigger and bigger. You see, the largest would be what? China Telecom has $30 billion of revenue. $48.9 billion of revenue of Gazprom. That's why you see Europe and everybody now crying for Gazprom. Why they are not supplying gas to Europe? So this is the largest. You see, no, the second largest. Petrobras is another one, Brazilian company, oil and gas, $56.3 billion of revenue. This is a massive revenue from emerging market. So emerging markets are nowadays coming up and also investing in developed market and taking control of businesses. We move to political risk, the second part. I will give a very brief introduction on this, and then we'll go for a break, and then we'll come back and do capital budgeting. Political risk is nothing to do with political parties. Let me tell you the first thing. Political risk has nothing to do with political parties. Political risk is something about, country risk. It's kind of, some people call it country risk. Now, these are, I cannot possibly show you more clearly. Red color means bad, green color means good, okay? Anything in between should be growing, okay? So you can see the red color countries, okay? And some countries risk is increasing, red means it's increasing, they are showing with arrow, and green means these countries are good and these are doing good. And all is not necessarily that, this is the information published in 2014, so it's very old information. You can look into the recent information, see which countries are growing and which countries are good for you to invest. Yeah, as I told you in the first class of international business, always red doesn't mean that you will not go to that country. Even Vietnam, you see it's a red color. Bangladesh is a red color. Doesn't mean that they are not getting investment. Even in pandemic, surprisingly, I was quite surprised. Bangladesh, even in pandemic, they managed to make last year $40 billion of export. Can you imagine? Their regular export is 44 billion. Their regular export per year is 44 billion. And even in pandemic, they managed to make $40 billion worth of export, which is amazing. I mean, so considering these countries as risky is not actually good. So this is the old information. If you update the information to 2020, possibly you will see some differences. You can search for this. I think it's MapleScroft. MapleScroft is a large company doing, it's MapleScroft. So search it, MapleScroft political risk analysis. You'll find out what is the recent political risk dynamic index of countries. You'll be able to decide which country possibly is the next good country for investment. Now, political risk can be divided into these three major components. As I said, political risk is nothing to do with political parties. Okay, nothing to do with political parties. It is the decision. It is the policy. Political risk is regarding the policy of the country rather than any political party or any political party's chaos. First type of risk is firm-specific risk, which is related to governance in that country, governance of a company in that country. So firm-specific risk, political risk, is generally connected to the company itself. It has very limited connection to the country. Some political risks are connected to country-specific risk. These are, for example, transfer risk, meaning that when you are having a subsidiary in Brunei, for example, if there's a transfer risk, meaning that there's a blockage of fund, you cannot transfer your money to other countries for a certain period of time. Okay, so blockage of fund. For example, Venezuela now has a blockage of fund. Russia has a limited blockage of fund. Turkey has a limited blockage of fund. So meaning that if you are investing in these countries, you won't be able to transfer 100% of your revenue outside to your mother company. So that's a risk that companies face. Cultural and institutional risk. These are also connected to a country. Cultural risk. Remember, I told you cultural risk, cultural shock, that can be a systematic risk. So, for example, ownership structures. Some countries, they have unique ownership structure. For example, in Brunei, in Malaysia, Indonesia, in Southeast Asia, if you want to own a business as a foreigner, a local has to be the real owner. Local has to be a real owner, unless you are a listed company. If you are a private limited company in Brunei also, it's kind of like a Alibaba style business where a local has to be the real owner. So ownership structure in the Middle East, in Europe, in Asia and Southeast Asia, the ownership structure is different. Human resource norms. A foreign company working in different countries will be facing different types of human resources problems. Some countries, for example, I can tell you about Malaysia, there are some discrimination going on against foreign workers. Locals get to work only 5 days a week with 120 ringgit per day, and they get lunch break, they get lunch money, they get insurance. But the migrant workers in Malaysia, they do not get 120 ringgit per day. They get only 50 ringgit per day. They don't have any insurance. They don't have any lunch break. They don't get any lunch money. So that is, human resource practices or norms in different countries. Religious heritage. Brunei, for example, has a religious heritage that pretty much dynamically control business operation. Halal issues, Sharia screening, these are regular issues in businesses in Malaysia, Indonesia, and also in Brunei Darussalam. Nepotism and corruption, there are a lot of countries in African region, there might be South American countries where you'll see, even in my country, in Bangladesh, in India, in China possibly, there are possibly issues of corruptions that become a part of that country's culture. And it can be problematic for foreign companies to eventually go into that country because it's not your culture. Corruption is not your culture, so you won't be able to operate properly. Intellectual property rights, there are violations of intellectual property rights. If this is there available in that country, you lose your innovation. So you may not want to do business with that country because your innovation will be lost. Your billion-dollar innovation will be lost. For example, Pfizer is currently producing capsules for COVID-19, and that's an intellectual property. But if they come to China, China will copy everything, and Pfizer will lose profit. So they don't want to go and establish their factory or R&D, research and development, in China. And I think US government has stopped doing business with number of Chinese companies recently. In the US, they have closed down number of factories of Chinese companies, citing the reason that Chinese companies in the US would be creating intellectual property issue that might be issue for national security for US. So that kind of risk is there. Protectionism. Some companies prefer kind of like local product over the foreign product. So they want to protect their industries. Therefore, this kind of protectionism is against globalization. Foreign companies, when they are going to a foreign country, if they see too much of protectionism, high level of protectionism, they don't want to go to those countries. One of those countries will be India. India try to protect their own own businesses over the interests of the foreign companies. That eventually create a lot of trouble for foreign companies to go to India and set up a business there. So possibly the best way to do business with India is through a joint venture, so that Indian government will feel that their own company is protected. Last one is global specific risks. Some political risks are global specific. For example, terrorism and war, even though we need to define properly what terrorism is, you cannot just say that this is terrorism and we are avoiding it. So terrorism is still a global threat and it's affecting us every day. War is happening everywhere because we want to sell our weapons. So war is happening even in ASEAN. Myanmar is affected severely with war. There are issues with Philippines. There are problems happening left and right in Indonesia as well. Not that much, but still there are issues happening in these countries. Therefore, war can be a serious issue for multinational company. Anti-globalization movement. Some countries, I don't know why, suddenly they feel that globalization is too much. It's affecting their industry. It's affecting their country. For example, Brexit has been the largest example of anti-globalization movement, where UK people have voted to go out of the European Union. You might be thinking that they have made a wrong decision, but UK general people, they are happy. They thought that the European people were taking too much of advantage from their country, so they wanted to go out, and that's why they went for Brexit. Environmental concern, there might be issues of, this is number one issue now. COP26 now was happening in Glasgow last week, and they tried to make a decision to reduce CO2 emission to go to something called net zero CO2 emission by 2030. So I'm not sure what's the development. As Greta Thunberg said, it's all blah, 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 meaning that nobody is actually committing anything to protect the global environment. So environment is now a major concern. You are establishing your factory into a location where there are higher environmental codes. You will have to change your manufacturing system so that you are not creating too much of CO2 emission. You might be thinking that just as a case, you might be thinking that electronic cars would be saving the global planet, right? It's not true, actually. The process of making electronic cars is actually hugely CO2 intensive or emission intensive task. So when you are producing those electronic cars, you are actually increasing CO2 emission into the atmosphere. So we need to carefully plan, possibly go back to the dark ages or stone ages, in order to save the planet. Planting more trees, reducing plastics, possibly also simplifying our lifestyle. We are too much. We are demanding too much. We are becoming too modern. Possibly these days, and creating a lot of problem for our own existence. Maybe a little bit of conservative strategy will help us to save the environment and save the world. Poverty is increasing. It's a massive challenge. It's one of the major challenge. Hunger is a major challenge globally. Obviously, you don't want to go to a country where their poverty index is very high. Many emerging countries are getting out of it, but still African countries, South American countries are still largely affected. I mean, it's not to talk about all these developing countries. If you go to US, you'll see a lot of homeless people affected by poverty issues. In Europe also, you'll see homeless people. So there are poverty issues in developed countries as well. Cyber attacks nowadays, it's a new thing going on for the last 10 years. You will use technology, you'll use cyber criminals to get financial assets and other assets outside of another country. So if your country is frequently affected by cyber terrorism, obviously foreign companies, multinational companies will not come to your country. So you need to safeguard yourself from cyber attacks. Many countries are centrally establishing anti-cyber terrorism team. So they have a massive team working to save the economy, save the country from cyber attacks. So these are major risks. You can now categorize your company, you profile your company based on this type of risk. There are explanations given for each of these. What is a governance risk? What can be different types of governance related risk? For example, whether your governance related risk could be firm specific, your company related decisions, whether you are going to source your raw material from local sources, whether you are going to have your factory location locally or somewhere else, what kind of transportation you are going to use, who will control the transportation, what kind of technology you are going to use, who will control the technology, what kind of market you are going to go into, who will control the market, brand name, trademark control, thin equity base, whether you are going to increase your equity or you are going to rely on leverage, multiple sources of borrowing, whether you are going to borrow from multiple sources or you're going to borrow from one or two sources, who is going to control your borrowing and other type of decisions. The description for country-specific risk is given here. Major country-specific risk would be transfer risk and cultural risk, as I told you. Let me give you some example of transfer risk. There can be blockage of funds, meaning that your company won't be able to transfer money, and also there are cultural shocks and institutional risk. There are some strategies given here. What you can do when the country is applying these control function, you can follow some of these strategies. These are country-specific risk and major strategies for those country-specific risks. For example, let's take one. What you can do if a country you're operating in is supporting protectionism. For example, in India, Indian government is protecting their local farms. So how you can do business in India? You will support government action to create regional markets. Okay, so you'll try to support the government initiative. So possibly you do a joint venture with a local farm, and then you'll try to support the government's initiative to save the local company that you are working with. Okay, so that's how you work in a protectionist country. For example, you are working in a country where there are strict human resource regulation that you have to recruit from local sources, local staffing. So what you do, the strategy is you'll do local management. Management employees will be coming from local staff, and also you'll do a lot of recruitment staffing from local human resources. Okay, so these are the strategies available. Go through them. Our main aspect is we will relate to these obviously in our decision making, but our main consideration is financial decision. Last one is global specific risk, some strategy, management strategy for global specific risk. For example, you are in a country where, for example, there is anti-globalization. So what do you do in a country where there is anti-globalization? Support government effort to reduce trade barriers, recognize that M&Es are the targets. Okay, so you need to talk to the government, do negotiation that your anti-globalization should not target the M&Es. But you may not have solutions, direct solution for all global specific risks. For example, cyber attacks, no effective strategy. No effective strategy except internet security effort. So sometimes your solutions, your strategies may not work directly, to save yourself from this global risk. Global risks are very large issue. It is very difficult to control, but companies will still try to find out solutions, negotiation with the government. They will also recruit lobbyists, lobbying firm to lobby in the government policies so that they can survive and also operate with profit. So these are the type of risk, three types of political risk, and there are strategies for each of these type of risks. Some are successful strategies, some are not that successful, very cost consuming. So you need to make the decisions very carefully. In the third section, we will move to capital budgeting decision. We will take a break for a short while, and we will come back after the break to discuss about capital budgeting decision using NPV, net present value, how multinational company makes investment decision. Okay, and we'll try to take an example. We'll try to go through the theory first, a few slides, only 5-6 slides, and then we will go to an example. I'll show you how this mathematical example is done. And then in the next class, inshallah, we'll look into more examples and we'll try to discuss. In the next class, I will ask you questions. So be ready to ask question to me as well. You can use the mic or raise your hand to ask questions. So let us do the theory and one practice today. And in the next class, I will upload some more practices and solution as well. So we'll take a break now. We'll take a break for 20 minutes. We'll come back at 10:10. Okay, 10:10 or 10:15. Okay, we'll come back at 10:15. Okay, everyone, welcome back. So we are discussing about political risk, and now we will move into capital budgeting, multinational capital budgeting. Now, capital budgeting it has a specific process that we need to follow, and the process includes estimation of cash flows and then using a technique to analyze the cash flow. So multinational capital budgeting, unlike traditional domestic capital budgeting, focuses on cash flows and outflows, inflows and outflows associated with prospective long-term investment projects across a number of countries and currencies. So in a domestic capital budgeting, we deal with cash inflows and outflows of a business only within the country. In a multinational capital budgeting, we deal with number of countries and number of currencies. That is what is the challenge of inflows and outflows. We need to minimize it. What are the basic steps? We need to identify initial capital investment, the amount of investment that you are putting at risk, or the initial investment or starting capital, starting investment. Second one is estimate cash flows to be derived from the or to be earned from the project over time. This normally is our income statement, starting from sales until net income. And identify appropriate discount rate to use in valuation. So you need to choose the K, remember the cost of capital, in order to calculate the present value. And apply traditional capital budgeting decision criteria such as NPV, IRR, or any other technique that you want to use in order to make the decision. So you need to use a decision tool. Analyze the prospect from subsidiary as well as parent company. So in a multinational company capital budgeting, you have subsidiary decision, you have parent company decision. So you need to make sure that you are deciding both for subsidiary and also for the parent company to eventually come to a decision whether this investment project is beneficial to the subsidiary and also to the parent. Ultimately, decision is made based on the parent company. So we need to finally come up to a conclusion that the investment that we are going to make is beneficial, is going to increase the value of the parent company. So decision will be eventually made based on parent company, but we need to analyze both subsidiary and the parent. So first we start with the subsidiary, then we move to the parent company decision. What are the complexities involved in capital budgeting project? Remember, capital budgeting projects are long-term projects. These are long-term investment made by a foreign company in a foreign location. So let's say a foreign company come to Brunei, they want to invest for 200 years, 100 years, 50 years, 30 years. You know, these are very long period of investment. And these involve huge amount of risk. For example, Hengji, you know, petrochemical investment. So that is basically refinery investment in one of the islands in Brunei. That's a long-term capital budgeting project. So this project involves risk. It involves massive amount of capital investments for a long period of time. Now, what are the complexities involved? Parent cash flows must be distinguished from the project cash flows. So you need to differentiate the contribution of the parent company or the risk to the parent company compared to the risk involved for the subsidiary. Parent cash flow often depend on the form of financing. So you need to decide possibly what should be the financing arrangement in the subsidiary location. Additional cash flows generated by the new investment in one foreign subsidiary may be in part or in whole taken away from another subsidiary. So if you are investing, for example, in Malaysian, you know, Sabah territory, for example, that will affect your investment in Kuala Lumpur as well, because Sabah is still within Malaysia. So your cash flows in Malaysia will be affected even if you are investing in Sabah and Sarawak. The parent must explicitly recognize remittance of funds because of different tax system. So different tax system in different country, legal system in different country, political constraint in different countries will affect the movement of funds. Therefore, the parent company, when they are analyzing the cash flows from each subsidiary, they will have to recognize the remittance of funds differently. Okay, that's a major challenge. Because if you are working in 50 countries and 50 countries have 30 different currencies, They have 20 different political systems. They have 10 different tax management systems. They have 5 different legal systems. So that is going to create a lot of differences and problems for multinational company financial managers. Complexities: an array of non-financial payments can generate cash flows from subsidiaries to the parent. So there might be payments related to, not related to debt and equity. So you may need to find out how you can pay the parent company using export, import payments, intra-company transactions, how you're going to pay salaries to the company officials, those are coming from mother company. You know, these strategies need to be aligned with the subsidiary company human resources policy. So some challenges are there. Manager must keep the possibility of unanticipated foreign exchange rate changes. So this is about foreign exchange exposure. So you need to make sure that foreign exchange rates are forecasted properly and applied so that you can reduce the risk of foreign exchange investment. Managers must keep the possibility of unanticipated foreign exchange rate changes in mind because of the possible direct effect on the value of the local cash flow, as well as indirect effect on the competitive position of the foreign subsidiary. So it does not only affect your competitiveness, it also affects your cash flows. Changes in exchange rate will affect your cash flows, will affect your competitive position at the home country and also at the foreign locations. Use of segmented national capital markets may create an opportunity for financial gains or may lead to additional financial cost. So which capital market you are working, how you're getting money from those capital markets, you need to have a good strategy for that. For example, if you are investing in Brunei, Brunei doesn't have a capital market, so you need to make a decision which capital market you go to raise funds. Do you go to Singapore or you go to Malaysia, Indonesia, Thailand? If you are using a segmented strategy for finding your capital from another market, it may increase your financing cost. Use of host government subsidized loans complicates both capital structure and the parent's ability to determine an appropriate weighted average cost of capital for discounting purposes. So sometime when you are investing in a foreign location, sometime the host government will give you loans, you know, subsidized loans. You can apply for it, and this is an initiative by the host government to maximize the foreign investment in their country. But when you take these host government loans, this may create problem with your capital structure, eventually creating a lot of challenges for your financing cost and also capital budgeting decision process. Managers must evaluate political risk because political events can drastically reduce the value of or availability of expected cash flow. So cash flow uncertainty might be there because of the political risk. You need to analyze these events carefully for each country separately and for each event separately, and identify the impact, measure the impact of that political risk event on the cash flow of the company. Terminal value, the last value that you receive from your cash flow, is more difficult to estimate often because you do not know the future also. The potential purchase from a host country, parent and third countries, or from the private and public sector may have widely divergent perspectives on the value to them of acquiring the project. The terminal value is when you are deciding to sell your business to another company. Okay, so it's the horizon value. Sometimes we call it horizon value or terminal value. This is salvage value. It includes the salvage value. So when you are selling your business to another party, there might be a number of factors that influence your price. For example, you might be affected by the decisions related to whether the host government is going to buy your project, whether the private company in the subsidiary location is going to buy your project. Who is going to buy your project will eventually determine the value. What you can charge, it depends on what you can charge, depends on who is going to buy your project at the end. So we look into terminal value when we do the calculations, and we'll see what are the factors that may influence our decision on terminal value. These are the type of cash flows that we deal with. First, there are three major types of cash flow. First one is the initial investment. That is the value of the machine or the project that you are buying, plus the increase in working capital if you need any working capital to invest in that country. Second is the incremental cash flow from investing in that country, from sales to net income, and then plus depreciation expense in order to find out the net cash flow. Finally, you have the terminal cash flow or the ending cash flow. That is basically salvage value of the project or the selling price of the project after tax and settlement of the working capital. The working capital that you have started working here, you need to settle it in the last stage. So these are the three major types of cash flows that we'll be dealing with. Once again, initial investment, incremental operating cash flows, and terminal cash flows. What are the methods? Typically, we use net present value, internal rate of return, payback period, discounted payback period, profitability analysis, and real options analysis. We will do only one here, in this course, and the reason we'll be doing only net present value because 95% of the companies use net present value, and that is the core of capital budgeting analysis. If you do net present value properly, you'll be able to estimate, the decision. You don't need to do other analysis. Okay, so that's the summary of this chapter. We will now go to one of the analysis that one of the cases that we have uploaded online already. You can find it. It's, I think, Vita Incorporation. Let me find the actual problem and solution. I have uploaded both, so you can download them. Capital budgeting problem. I think this is the one, the Vita Dell Incorporation. So I'll go through the case first, and then we'll show you how the solution is done. And it will take some time for you to grab the situation, but hopefully you'll be able to do it by the next class. So this is an investment proposal for Vita Dell Incorporation. It is investing in Malaysian market. And let's go through it step by step. Let me see whether I can have a highlighter or something. That's typical. Oh, sorry, it's here. I can yellow color. Okay, so it's planning to expand its operation to Malaysian market. Okay, so the company is targeting the smart sport watch segment of the market. Initial market research finds a high growth potential for the company. The investment in Malaysia will be a greenfield, meaning that this is a new investment, and Vita Dell has already obtained permission from the relevant authorities to set up factories in Penang, a famous tourist destination in Malaysia. Vita Dell's initial investment in Malaysia includes purchasing, so initial investment, okay, they directly say this is an initial investment in Malaysia, purchasing watch processing plant, and it will cost the company RM 150 million. So the case, I think case has a problem here. So they are saying that it's a greenfield investment, but then they are saying that it's a purchasing of processing plant. So meaning that, whoever wrote the case, because I actually bought this case. So whoever wrote the case, they have problem of theory, If you have a greenfield, you cannot have at the same time purchasing what do you call it, the project from an existing company. Vita Dell offers an additional working capital, so additional working capital loan of RM 10 million. Plan modification cost. There is a modification cost. Plan modification cost is estimated to be RM 10 million. The project is estimated to run for the next 4 years. This is a vital information. So this project is going to last for next 4 years. Okay, so I will pause for 1 minute. You go through this vital information again. Okay, let's go to the next paragraph. See how it influences our cash flow decision. Vita Dell has signed MOU with the Malaysian government the MOU allows the company to pay tax at 20%. So tax rate, the Malaysian tax rate is 20%. Okay, so for the this tax rate is for the first 2 years, and 25% rate for the remaining 2 years. So you must be very careful. So first 2 years, this company will pay 20%, 20%. Third and fourth year, they will pay 25%, 25%. The government of Malaysia has accepted the offer to purchase the plant at the end of its operating life at book value. Okay, at the end of year 4, Malaysian government will buy the project at book value. The MOU has also allowed Vitadel to pay reduced rate of withholding tax. Okay, a rate of withholding tax is 5% for the first 2 years and 10% rate for the remaining 2 years. First 2 year 5% and 10% rate for the remaining 2 years. Let me explain what is withholding tax. Every year when the foreign company transfer revenue to their mother company, they will have to pay a certain amount of taxes on the transfer of the money. So if you transfer your revenue from Brunei to the mother company in the US, you have to pay 5% tax. This 5% tax in the first 2 years and 10% tax on your transfer in the next 2 years. Okay, next is Vitadel can transfer 100% of its income, so there is no blockage of fund. It can transfer 100% to the mother company. Okay. The government of Malaysia offers an alternative to Vitadel, okay, to accumulate all the yearly income, invest and transfer at the end of year 4. So instead of transferring every year, Vitadel has given an option by the Malaysian government that you can transfer everything at the end of year 4. In return, the government of Malaysia will allow the income to be reinvested in Malaysian securities market that earns an average return of 12% per annum. So instead of investing and transferring every year to your mother company in the US, you can actually transfer everything at the end of year 4, okay? And you can earn 12% per annum until the year 4, and the government will not charge any withholding tax for the transfer at the end. So if you transfer every year, you will be charged 5% first 2 years, 10% second 2 years. But if you invest in Malaysian market for next 4 years, at the end of 4 years, you can transfer everything without any withholding tax, and you will earn 12% per annum. So this is a benefit given by Malaysian government to the company so that the company, consider the alternative. Vitadel will use straight line depreciation, and a flat rate of 20% per annum will be used over the operating life of the machine. So depreciation rate is 20% per annum. Okay, so we'll take a minute. We pause for a minute and look into the second paragraph and see whether any information that can create some problem later on. Just look into the information. Okay, so let's move on to the next paragraph. Pre-tax earnings So they are not giving you sales information. They are making your life a little bit easier. So the company has pre-tax earnings after depreciation. This is after depreciation per annum estimated to be RM 50 million in the first year. And the earnings are estimated to grow at 15% rate per annum for the next 3 years. So in the second year, third year, fourth year, the earnings 50 million will increase by 15% per year. The spot rate of currency, spot rate of the Malaysian ringgit to United States dollar is given USD 1 to RM 1.15, 4.15, sorry. Inflation rate in the United States is 2%. You need inflation rate to forecast foreign exchange rate. And this rate is expected to be the same for the next 4 years. Malaysian inflation rate, however, is expected to change. The present rate in Malaysia is 2%. It will be 3, 2, 1, 1 in the next 4 years. Required rate of return on similar project is 15%. So K is given, K is 15%. Not always K will be given. You may need to also calculate K sometime, but here it is given, K is 15% for the first 2 years and 18% for the remaining 2 years. So 15% and 18%. Okay, so we take 1 minute, just pause for 1 minute and look into this paragraph, see whether any information. So they are not giving us sales, they are giving us pre-tax earnings. So in the operating cash flow, we'll start with pre-tax earnings. Okay, so what do you have to do? Questions. Evaluate the proposal for beta del for the parent as well as subsidiary. You see, you need to do both. And after analyzing the trends of exchange rate between Malaysian ringgit and the United States dollar, should Vitadel accept the alternative to remit its income to the parent? Okay, so instead of transferring every year, should they transfer everything at the end of year 4? Note that at present the plan is to remit subsidiary income each year. So current plan is to transfer subsidiary income each year, but the alternative plan is to transfer everything at the end of year 4. Okay, so we need to do calculation to show that. Discuss the impact of political risk on your evaluation of the above project. Okay, so these are the requirements, and we will now go to show you the solution. And it is not surprising that you will have a lot of problem with the solution. No problem, solution is already uploaded. You can go through them, and we will do another one in the next class, and also solution will be uploaded. So possibly the confusions will go. Let me now take you to the solution file. Normally, if we have physical class, I will be doing this in the class itself. So since lockdown has taken a lot of fun from our life, so I would have been physically doing this in the class, literally writing everything so that you understand how things are happening. Okay, now here I have shown you both. After the first tab is after depreciation EBT. If the depreciation, according to our example, pre-tax earnings is after depreciation. Okay, so I have shown you both. I have shown you after depreciation. I have shown you before depreciation. I have shown you both. Okay, so I will do only after depreciation in the class. You can later on go through the before depreciation one. Okay, let's go one by one. Our calculation start with initial investment, and in initial investment we have the planned cost 150 million, and these are all negative figure because these are cash outflow. We have a modification cost, plant modification cost 10 million, working capital of 10 million, total is 170 million. This is our initial investment. Now always remember, any modification cost, this one, modification cost, will not be included in depreciation. Let me repeat, modification cost will not be included in depreciation. Depreciation is generally calculated only on the planned cost. Okay, so modification cost will not be included in depreciation cost, but sometimes depends on asset also, depends on asset. Sometimes if the asset is only machine, it's not a plant, or if the plant is only a machine, okay, then the modification cost might be included. For example, this company machine is a mobile phone manufacturing machine, something like that, mobile phone manufacturing machine. So this machine modification cost might be included into the calculation of depreciation. So we'll go through it. We'll show you how it is calculated. There might be other costs in initial investment which is not part of this case. For example, shipping and installation cost. Okay, for example, you are bringing the machine from China. You don't have the machine here. You are bringing the machine from China, and there is a shipping cost included, right? Shipping cost needed to bring the machine from China. That shipping cost can be included into initial investment, but the shipping cost will not be included for depreciation. Okay, shipping cost will not be included for depreciation. Okay, next one, operating cash flow. We don't have any sales. We don't have any cost of goods sold. First, what we need to do is we need to identify the time. Remember, our time is zero period is the current period. Then the project will go to year 1, year 2, year 3, year 4. If you check the question, the project will run for 4 years. So we need to do the cash flow estimation for 4 years. The initial investment is happening in the 0 year. Initial investment is happening in the 0 year because no production started yet. So everything happens, initial investment happens in the 0 year. But operating cash flow start from year 1 because you are starting operation now. Okay, our operating cash flow includes earnings before tax, but after depreciation, right? So this starts here and it grows at 15% rate, if you remember. So in the first year is 50 million, and then from the next year, this one will grow at 15%, 15% of 50,000, then 15% of 57.5, 15% of 66.125. So each year it will go at 15% rate until year 4. Next one is minus tax. After earnings before tax, you need to deduct tax rate. Remember, the tax rate is 20% in the first 2 years and 25% in year 3 and year 4. So you just calculate the tax on the EBT, earnings before tax, and these are the tax figure. These are in negative figure. Okay. Next is net income. After tax, we don't have any interest. Remember, we are not getting any loan from the bank. Rather, we are getting working capital from the mother company. So there is no interest involved. So we are not paying any interest. So we'll directly calculate net income. EBT minus tax is the net income. And after net income, the policy of operating cash flow is we'll add depreciation. The depreciation will be added because it's a non-cash flow, non-expense cash flow. We are not paying anything in terms of cash, so we'll add back depreciation. And this depreciation is 20% flat rate, right? So there is a note given here for you how the depreciation is calculated. Depreciation total cost of the plan multiplied by depreciation charge. Okay, percentage flat rate 20%. The total cost is, you see now 150 million is the basic cost plus 10 million is the modification cost. So they have added 10 million because this plant includes a machine where the modification of the machine will be included into depreciation. So this plant includes a pure machine. Okay, sometime your plant may include machine plus other thing. Okay, maybe it includes land, it includes, other non-physical, non-fixed asset. So if you have non-fixed asset or cost that is non-fixed, you don't need to calculate that one for depreciation. For example, installation cost or shipping cost, transportation cost. These are non-fixed element, non-fixed asset element. These are still cost, initial cost connected to the machine, but these are not directly going to change any characteristics of the machine. Therefore, the depreciation cost on the machine would be the pure cost of the machine plus any modification cost of the machine. So 160 million total multiplied by flat rate 20% is 32 million each year. So we'll now put this 32 million in the depreciation. You see 32 million, 32 million, 32 million, 32 million. So net operating cash flow is the plus minus of these figures, and we found out 72 million, 78 million, 81.593 million, 89.032 million. These are the operating cash flow for year 1 to year 4. Okay, now let us move to the last part, which is our terminal cash flow. In the terminal cash flow, we will have salvage value equals the book value. Okay, so the Malaysian government will purchase the project after 4 years at book value, right? Now, what is the book value? Book value is the remaining value after depreciation, right? Book value is the remaining value after depreciation. So if you are depreciating at 20% flat rate, look at this 20% flat rate for 4 years. So 4 years multiplied by 20% is 80% depreciated, right? So the book value would be the remaining 20%. The remaining 20% is the book value of the machine. So this is 32 million. And there is a note given here. You can go to the note. If depreciation covers 20% multiplied by 4, 80% of the machine in 4 years, remaining 20% value is the book value. Hence, the book value is 20% of 160 million, which is RM 32 million. Next one is working capital return. Remember, working capital previously was a positive figure, negative figure. You see, this one 10 million is a negative figure, meaning that this is a net cash outflow for the mother company. So now you need to give it back to the mother company, right? You have taken working capital, some financial help to start the business from the mother company. So you need to now return it to parent. You see, return it to the parent company. So when you return it to the parent company, it should be a positive cash flow to the parent company. Okay. Altogether, you have a 42 million is the terminal cash flow. Now you can add all, or bring down this 170 million is here. You have 72 million. You have 78 million. You have 81.593. And then you have 89.032 million here. And you have a 42 million payment here. Add these two together, you get 131,032,813 million as your terminal cash flow. So each year you have cash inflow and outflow, right? So 0 year you have cash outflow, and all other 4 years you have incremental cash flows from year 1 to year 4. Now you can do basic analysis, right? Your cost of capital, K, for the first 2 years, you have 15% and 15%. Year 0 is also 15%, but year 3 and year 4 is 18% and 18%, right? So you can now calculate the present value, cash flow divided by 1 plus K to the power T, right? Cash flow divided by 1 plus K to the power T. The equation is given here. You can click this and double click it to see the calculation is done. Cash flow E26 divided by 1 plus K to the power T. Each of these are calculated in a similar way. Okay, so cash flow divided by 1 plus K to the power T is the present value calculated. Add all the present value. First one is a cash outflow, all other cash inflow. If you add them all, you will get the net present value, summation of all the present value as your net present value of the firm. Now, the rule of thumb is based on this is the subsidiary operation. Based on the subsidiary operation, accept the project because NPV is positive. So if the NPV is positive, we will accept the project. So this NPV is 68 million positive. We will accept the project. So subsidiary operation is accepted. Now we need to see for the parent company. Whether the decision stays or not, or the decision changes. In the parent company, what we have to do, we have to transfer the cash flow, right? Transfer the cash flow from the subsidiary company to the parent company. Now there are two options given. Remember, the first option is the regular option. We transfer everything each year basis. We will transfer everything in the first year, second year, third year, fourth year, right? And we will pay the withholding tax. But in option 2, we have the company, the Malaysian government has given us an offer that we can invest it at 12% rate every year, and in the 4th year we can transfer everything to our mother company. If we transfer that in the 4th year, we will not be charged any withholding tax. Okay, so let us move on and see our net cash flow from the subsidiary company is this. This is coming from the previous calculation, and then minus withholding tax. So we are going to transfer this cash flow, right? So we pay the withholding tax in Malaysia. So the withholding tax are calculated. This is first 2 years would be, I think, 5%, and the second 2 years would be 10% and 10%, right? So after the withholding tax, these are the funds ready to transfer. These are the funds now ready to transfer to US. Now, in order to transfer to US, we need to convert it based on exchange rate, right? So the exchange rate, we need to calculate them. Okay, the current exchange rate is given, 4.150 is given in the question paper, and the remaining exchange rate we need to calculate. Okay, so we will now go to the slide where, or go to the Excel sheet where we are calculating the exchange rate. Look at this Excel tab here, exchange rate calculation. So let me go here, exchange rate, how they have calculated. Okay, this is the exchange rate based on inflation rate difference. Remember PPP, purchasing power parity theory, we have discussed in 2nd class. This purchasing power parity theory will be used to calculate exchange rate, right? So US is our home country. We have the inflation rate of 2% and all 2%, right? And Malaysia is our foreign country, is the foreign subsidiary. So they have 2%, then 3%, 2%, 1%, 1%. These rates are given. Okay. So what we have done according to PPP, if you go back to the slide, you will see that there is a EF percentage that we can calculate. The EF percentage is calculated based on this equation, right? 1 plus inflation rate home divided by 1 plus inflation rate foreign minus 1. So this EF percentage is calculated based on inflation rate differential. First year inflation rate differential is 0.00971. Okay, so this is basically 0.971%. So almost the difference is 1%, right? Second year inflation rate differential is 0. So the difference is 0%. Third year inflation rate difference is again 1%. So it is 0.009901. Okay, so almost 1% difference. In the 4th year, the inflation rate difference again 1%. So it is exact figure is 0.009901%. Okay, so now based on these differences, EF percentage, we need to calculate the foreign currency rate. So there is an explanation given here. For example, negative 0.00971, meaning that the foreign currency will depreciate. Foreign currency will depreciate by almost 1%. So if the foreign currency depreciate, your local currency will be appreciated. Okay, opposite. So Malaysian exchange rate is given for US is 4.15 in 0 year. If the foreign currency, Malaysian currency, is depreciated by 1%, you need more foreign currency, you need more Malaysian ringgit to get US dollar. So you need 4.19 instead of 4.15, right? 1% extra. In the next case, you have difference 0, meaning that you need the same exchange rate, 4.190. Next year, you have 1% difference again, but this time 1% positive, meaning that your foreign currency will be appreciated. So you need less Malaysian ringgit. From 4.19, it becomes 4.149. You need less Malaysian ringgit, right? In the last year, US home inflation rate is high, so Malaysian ringgit will be further strengthened. So from 1.4149, it becomes 4.108. So Malaysian ringgit is becoming stronger because their inflation rate is low. So these exchange rate we will now transfer to our actual calculation. You see, these are the exchange rate transferred, 4.190 for let me check. Yeah, 4.190, 4.190 first 2 years same, and then 4.149 and then 4.108, right? So this exchange rate now used to calculate and transfer Malaysian ringgit to USD, right? So when you have the exchange rate, calculation is very easy. You just multiply with the exchange rate, or in this case, you will divide 170 million divided by the exchange rate 4.150. When you divide it, you get 40 million
as cash outflow, 16 million as first year, 17 million second year, 17.699 third year, and fourth year you have 28.707 million. Now calculate present value. Our cost of capital is same as previous cases, 15%, 15%, first 2 years, and then 18%, 18% second, third year, and the fourth year. When you divide cash flow divided by 1 plus k to the power t, you get the present value. Add all the present value, you get the net present value. There is a mistake here. This net present value RM, sorry, it should be dollar. This RM should be dollar. Okay, now since you have this net present value calculated, you can now make a decision. If your net present value is positive, you accept the project. So for the parent company, with the first option, net present value is 12.183 million US dollars. So we'll accept the project. Okay, now we go to the option 2. What was the option 2? American government, Malaysian government has given us an option that we can invest in Malaysian market for next 4 years and transfer everything. At the end of 4 years, we don't have to pay any withholding tax. We will now see whether that option is beneficial for the company. So our cash flow, we start with our cash flow, 170 million, 72, 78, 80, 81, and 131. What we will do, invest, right? We will invest at 12% rate. Remember 12% rate per annum, right? So you see these are the investment. Let me make it a little bit zoom into it. So first year, you see the green color or the blue color. I'm becoming colorblind day by day. This is the first one. Year 1, 72 million invested for next 3 years, right? You are investing it for year 2, year 3, year 4. So it becomes 101.154 million. So 72 million becomes this one after 4 years. Then you are investing the second one, 78 million. This is becoming 97 million after year 4 on the year 4 when you are transferring everything back to US. And then the third year you have 81.593 million, which you are investing for 1 year. Okay, year 3 and year 4, you are investing for 1 year. Later, you can check the equation, how it is calculated. And this one investing for 1 year at 12% rate, it will be 91.385 million, right? So these are the three. And the last year you see you have 131 million, right? Last year you are investing this one for 0 period. 0 period at 12%, meaning that the figure will be same. So this is that straight coming down, 131.032 million. Altogether, your investment becomes 421.415 million altogether in Malaysian ringgit after 4 years. Now, you don't have to pay any withholding tax, remember? So if you don't pay any withholding tax, the next process is simple. The total savings, the cash outflow is 170 million, and in the next 3 years, there is nothing. In the last year, you have 421 million. That will be transferred after all savings and return. Now this will be transferred to US. In order to transfer, you need the exchange rate. We have calculated exchange rate already. And what you need to do is divide with the exchange rate. 170 million divided by 4.15 is 40.963. And then you have the last one, which is 421 divided by 4.108, which is 102 million, right? Now the cost of capital in order to calculate present value is 15% in the 0 year, and there is no other cash flow here. In the 4th year, cost of capital is 18% already given. So we have calculated the present value. Cash outflow is 40.963, and then for the cash inflow last year is 52.911 million. Once again, this RM is wrong. It should be dollar value. It should be US dollar after conversion. So in US dollar, the difference between these two is 11.947 million. So net present value is 11.947. So let's see which one is bigger. In the previous case, it was 12.183, and in the second case, it is 11.947. So Malaysian government, even though they have offered us to invest at 12% rate, we are not going to take option B, right? Take option A, since option B is offering lower NPV. So because of slightly lower NPV, we will take option A, and we will try to transfer money after paying the withholding tax every year, year 1, year 2, year 3, and year 4. Okay, so the scenario of after debt EBT is quite likely, unlike the second tab before the depreciation EBT. So you can also look into before depreciation EBT, see how the calculation are different. But our main consideration is after depreciation EBT. As additional calculation in the exam, you have to show exchange rate calculation. You will also have to show the depreciation and book value information, and maybe you will also have to show the cost of capital calculation. If you need to calculate cost of capital, you need to show the calculation for it. I will try to find out an example where we need to show you the cost of capital calculation, okay? So that we have an exercise on that too. That's all. Our capital budgeting calculation and solutions are already uploaded. You can go through these through the Excel file, see whether there is anything that you do not understand. I don't want to give you any more information today. It's too much of information already. But try not to miss next class. I will try to upload some extra question for you, practices for you to go through them, so that we can have proper exercise before we sit for test 2. I will see you in the next class. I will not give you any more information. It's too much already for today. Go through this again. If you find any problem, please let me know. Okay, thank you very much. We have completed our formal chapters, our formal discussion for the semester. I would like to thank you all for doing this. This has been really tough for all of us in Brunei. Alhamdulillah, the number of cases now is gradually is showing some good sign, but it's still I think you need to be careful, and vaccination is a must, especially kids. 17 to 12 to 17 adolescent vaccine is, I think, already in Brunei. Inshallah, I think from today they are supposed to start. So be very careful and participate in the vaccination program. Motivate our parents to send their kids for vaccination. This is the only way out. In economic sense, you cannot have lockdown anymore. The period for lockdown is over. The more lockdown you have, your economy will break down. So, all the governments in the world, they are trying to get out of the lockdown as soon as possible, because you have to run the country. Lockdown is not a solution. So inshallah, we'll go out of this, and we'll try our best to accommodate any shock, in a fruitful manner, inshallah. So if you have any question, once again, write to me, email me, and by this time, what I will do, what I owe you is I will try to compile some more examples for both the transaction exposure and also for capital budgeting. I will try to do at least 1 or 2 more, and with solutions, I will try to upload them on the Canvas. And in the next class, we will try to discuss them, so that if there is any point that still remaining that we need to discuss, we can find them out and try to find a solution for them. And your exam test 2 would be immediately after that next week. I think what is that? 9, 9, 18, 9, 7, 16. So I don't know around what. Let me check. Your test is going to take place on 23rd. So our next class is revision week, 16th of November, and then we have 23rd is our online test, and your final assignment submission and link submission for presentation is on 30th November. So I have uploaded already, open folder already on Canvas. You can go through them. Let me show you something before we close this session. In the Canvas page, for you to take advantage of the folder that we have open for you. For example, if you go to the assignments, you'll be able to see them when these are open for you. For example, the final assignment folder is already open. So if you are finished with the final assignment, you can submit anytime. But you can only submit, I think, Word file. It's only a doc file you need to submit, or a docx format, docx format. No other file format, PDF and anything else will be accepted. No Excel will be accepted. So it is only a Word file. So if you have anything in Excel, you try to copy them and paste it in the Word file and submit it accordingly. It's a Turnitin enabled folder, so be very careful. I'm allowing you to submit twice, okay, maximum 2 times. These are allowable submissions, okay. So if first time your Turnitin score is very high, you can do it, you can submit again, but make sure that you are deleting the first submission. Late submissions are absolutely not accepted at all. So there is 35% mark for it. Be very careful, don't lose any mark here. These are easy marks to grab so that you can increase your grade. And also another thing is final assignment presentation link. I think you can see this. If you click it here, it is only for pasting your assignment presentation link here. Okay. Now there are 2 ways you can do it. If I can show you student view, let me show you how it is done. Let's say start assignment. If you go inside, I have given you a number of options to paste it. You can directly paste a link here, text entry, just paste the link and submit. Or you can go to website URL, the Google Drive link, you know, for the presentation, Google Drive link or Microsoft, OneDrive link, whatever link you have, YouTube link, whatever link you have, you can paste the link here. I will get it. Or if you have a small media file, video file for 10 minutes, for example, if it is small in size, you know, not that very big, you know, if it is 50, 60 megabyte, that we can cover. You can directly paste it here, or you can upload. You can click this link. You can upload the video in this space. If you upload the media, I can directly see it here. But if you just paste it, I'll have to click it to go to your site. But the common suggestion is the sorry, stay on the page. I need to cancel it first. I think sorry, cancel. Leave the student view. Okay, just a minute. The common suggestion is when you are uploading a link or giving me a link. What is the problem? Okay, student view out. So when you are pasting a link, or let's say you are sharing a Google Drive link or any other link, keep the file there for at least 2 weeks. Okay, don't delete it. If you delete it after 1 week, if I'm still not checking your assignment, you'll be given 0. So at least keep it for 2 to 3 weeks there so that I can finish the assessment. And once you see your grade, then you can delete it possibly. Do not directly delete the entire file. You can keep a copy for your record later if anything happens. So just be careful about the presentation uploading of the media file. Okay. Is there, if there's any question that you have regarding the submission of the assignment, submission of the, you know, the tutor, the presentation link, let me know. Send me an email. I'll try to instantly come back to you and try to give you a solution. But late assignment, late submission will not be accepted. Late submission will not be accepted. Do not keep everything for the last moment. The reason why I extended your time by at least 2 to 3 weeks is because I want to give you sufficient time so that you know you are not overburdened with too much of assignment. So that's why I have you know, extended the limit. Now don't take it as a you know, as an advantage from your side. Try to submit 1 or 2 days early so that if you see any problem, you can submit it another time. Okay, so try to submit first submission 1 or 2 days early. And if you see Turnitin score or any other score is very high, you can submit it, resubmit again. Okay, so if you have question later on, you can email me. I'll try to come back to you. All the best to you all, and see you in the next class with additional exercise, and we'll try to prepare ourselves for the test. Thank you very much.